Hello and welcome to Metro Magazine. I'm Tanya Dallas Lewis. You know, having weathered 2 years of a troubled economy, millions of Americans are extremely worried about their retirement funds. Well, joining us today is investment advisor Joe Luby of Jagen Funds, and he has all the answers. Isn't that right, Joe?
I hope so.
Well, thank you so much for joining us. And you're actually here in town. You're from Las Vegas.
Yes.
Tell us why you're here.
We're in town for a conference and a series of meetings, and
Okay.
we're headed back out later this afternoon, in fact.
Wow. Well, we're so glad that you stopped by our little old Metro magazine. Now, tell us a little bit about your background and why you found yourself in this career path. You're president of Jagen Funds, and you're a financial planner, and you're an investment advisor. That's a lot of stuff.
Right. Well, it started. It's really probably my father's fault. He was a tax lawyer for his entire career, and when I was 10, he had me buying my first share of stock, and so that was the type of conversation that went on, and it just sort of piqued an interest. And as I got into my adult career life, I did a few other things first and sort of got those out of my system, and then settled down to this path and never looked back.
Well, you are a gem to many people. There's so many questions that people have, especially with the economy on the decline. Let's talk really briefly about taxes, preparing 2011 taxes now. What is your input about that?
Sure. This is a good time to start looking at 2011 because we already know that tax rates are going up. If Congress doesn't act between now and the end of the year, then as of January 1st, a lot of things are going to change in the tax code. We're going to go back to a lot of the things we had before what are now called the Bush tax cuts.
Okay.
So several tax brackets are actually going to increase. Dividend income from stocks and mutual funds, things like that, are going to be taxed as ordinary income rather than at the lower 15% rate we have now. Capital gains taxes are going to go up from essentially from 15% to 20%. So there's a lot of things on the horizon, again, if Congress doesn't act between now and then to make some changes. So folks who are going to be affected by these things ought to be looking at it today.
So speaking of looking at things today, what would you advise, regular folks, Americans, when it comes to this year and completing a Roth conversion?
The Roth conversion opportunity is very unique this year. Previously, not everybody could do a Roth conversion. You had to have your income below certain levels, and as of January 1 this year, that restriction went away. So now anybody can do a conversion regardless of income. And there's another unique feature to it this year. If a person does a conversion this year in 2010, they have a choice of when they pay the tax. Because typically you take a traditional IRA and you convert it into a Roth IRA. That's the conversion process. But the dollars that are in the traditional IRA have not been subject to tax before, and so you have to pay tax on them at the time of the conversion. Well, as of 2010, if the conversion is completed this calendar year, you have a choice of either paying the tax on your 2010 tax return, or you can defer it for 2 years and pay half of it in 2011 and half of it in 2012. And you got to run the numbers a little bit to see which of those makes the most sense in a person's particular case, but you at least have that opportunity to decide when and how you want to pay the tax.
Okay.
The other interesting part about the Roth conversion is you can't lose.
Okay.
There's no way to lose because it's one of the only things in the tax code where you get the chance to change your mind afterwards. So if you do a Roth conversion in 2010, then you actually have, or the person has, all the way until October 15th of 2011. It's all the way to your tax filing deadline, including the extension. So if you do an extension, don't file in April, you have until October 15th next year. You have that long to decide if it was a good idea or not. And if you decide later it wasn't a good idea, you can what's called recharacterize your IRA and put it back into the traditional IRA, and it's as though nothing happened, no harm, no foul.
Wow, well that's good to know. So that's why I'm glad you stopped by Metro Magazine to share that with us. Now let's talk about estate planning taxes. That's a big deal for a lot of people, and it's going to depend on what Congress is going to do. Talk to us about how, depending on Congress, what action I guess Congress takes, how this doesn't just affect the wealthy.
That's right. As of right now, this year, as we sit, there is no estate tax. So that we actually had what they call a repeal of the estate tax for 2010. And if Congress does not act, again, through the rest of this year, then January 1 next year, another one of these big changes is coming, and we go back to the rules we had several years prior, which
Right.
is essentially $1 million exemption. So families can, or individuals who pass away with less than $1 million in total assets are going to be exempt from the tax, but anything over $1 million would be subject to the tax. And the tax rate itself goes back up to as high as 55%. And what happens come next year, again, assuming they don't act to make a change in this rule, is that an awful lot of people will be caught in the estate tax system that otherwise wouldn't have, or who don't even think that they will be. Because one of the most common things we see is you've got a married couple and they have a house and a couple of cars and some possessions and their 401ks and their IRAs and maybe some pension dollars from their company, and then they have a life insurance policy. Very, very typical that the breadwinner, be the husband or the wife, has a pretty substantial life insurance policy on themselves to protect the family if something happens to them. Well, that policy, if it's not owned properly, if it's not owned correctly, is actually part of their estate for estate tax calculations. So if somebody owns a simple term insurance policy for $1 million, let's say, they're now in an estate tax scenario come January 1st next year.
Wow, I did not know that.
It's one of those tax traps that
Yikes.
most people don't realize, and they'll come in the office and we'll be looking at their stuff and we'll get the joy of telling them, hey, did you know you're going to be subject to the estate tax? And they think, well, I'm not rich, I don't have a lot of money, why would I pay an estate tax?
Wow.
And there's a lot of little things like that that are not as well known, not as well written about, or people just don't realize that.
So what is the answer to that? What that's a hypothetical scenario, but it is going to happen when they say to you, hey, I'm not rich. Why does that apply to me? What if they say, what can I do about it? What can you do about it?
There are strategies you can employ. You can change the ownership of the life insurance policy. You can put it, there's a special kind of trust that can hold that policy that will protect it from that estate tax issue. And there's a variety of other ways to look at solving the estate tax problem. And again, they use sometimes it's different trusts, sometimes it's transferring assets while they're still alive, things like that. So there are solutions out there, but if they're not going in and talking to somebody about it, if they're not sitting down with a planner who's looking at their entire financial picture and bringing these to the table to discuss and solve, then they're going to get caught.